Welcome to It's the Economy. The economy has been exposed to a bunch of negative and positive forces in the past 1 month. The negatives include a threat of course, 6 to 10% or even higher tariffs on our exports to the US, 2 relentless FPI outflows due to perceived strong growth in the US, 3 a rising dollar and a rapidly falling rupee. On the positive side, however, our strong boost to growth from the budget, heavy capex spending by the central government, especially in December, if you looked at the numbers, a rate cut from the Reserve Bank, and the latest, a continued liquidity boost for the banking system. Are the positives enough to beat the negatives and push up growth next year? We will know a little bit from the Friday GDP numbers, but we will know a lot more if we listen to Soumya Kanti Ghosh, the Chief Economic Advisor of State Bank of India, who joins us. Soumya is also a member of the 16th Finance Commission, member of many committees appointed by the MOSPI to revamp IIP, CPI, etc. So a person who's going to give us a many-sided perspective. Soumya, thank you very much for sparing time in what are busy days for you. First up, what's your sense of the US tariffs itself? We are told that it's the entire US exports, India exports to US is only 2% of our GDP. So is it a lot of noise but not a big bother?
Thank you, Latha, for having me on the show. I think it's a bit of both. It's also a noise, but we also need to understand the intricacies of these tariff issues. I think there are 3 things we must remember in our quest for this tariff issue. The first thing is the role of China. If you actually look into the China's share of imports in computer peripherals, industrial equipment, telecom instruments, and electronic components, basically all those, that share is at 44%. And a large part of this global share of China actually goes to USA, which are then exported. And if you look into the US export share of the commodities, basically of which is more than 30 to 35%, pharmaceuticals is one of them, cotton, ready-made textiles is one of them, and pearls is one of them. So this is the first part is the Chinese large share of China's imports into global commodity manufacturing. Second is the US share. And the third is where does India stand over there. If we actually look into India, the US exports, the US imports from USA actually dominate a significant part of its intermediate sector rather than the final sector. And most of these sectors are in the minings, petrochemicals, iron and steel, and it is spread across almost all categories. So my sense is that even though on an overall basis, if we, for example, say a tariff imposition of 20% flat, that could happen, say, 3 to 3.5% of a decline in Indian exports to US. Okay. India runs an exports trade surplus around 45.7 billion last year. But on an overall macro level, I think the disturbances, the impact on inflation could actually also be, I'll not call it meaningful, but also it could be disruptive in the world economic order.
Oh, okay. That's a separate issue. But first, importantly, macroeconomy growth is not terribly impacted by the US noise. Of course, specific sectors like gems and jewelry or textiles or pharma and chemicals, we will have to look at separately, but it's not a macro impact. What is your sense of inflation? I thought that if China is prevented from sending too much to the US, it will become a disinflationary force for the rest of the world because it will dump. What's your sense? Global inflation goes up or disinflation comes in?
I think in terms of the global inflation, I think the picture is not yet uncertain because the US is still not decided on how to go about the imports because it had imposed a tariff rate on some of the countries. Then it said that it will again go on to March. So that picture is not clear. But to your specific point on whether it should be inflationary or deflationary, I think the jury is still going to be out because if the Chinese share, if you look into if China is not allowed to export a large part of because of the tariff imposition and is because of dumping, that will also lead to some industry issues in some of the emerging economies. For example, iron and steel is the obvious choice, and that could lead to some sort of an overall disturbance. So I think that is not going to be too good in terms of a developing economy.
Okay, but what about our inflation trajectory and rate cuts from the Reserve Bank itself? What did the minutes tell you? Did they sound dovish enough to expect 1, 2, 3 more cuts?
Yes, I think, Latha, the minutes, if I can peruse the minutes which were published last Friday, I think the minutes are dovish. across all the members, including the RBI governor and also the ED. The most important point to note is that there has been concerns on the whether the interest rate would be used as an extended defense, but most of them has said that the time is now right to give growth and chance, and possibly the minutes foretell that there are possibly at least 2 rate cuts in the month of April and June, if not more, depending on how the growth reacts in the coming days.
Okay. So how many rate cuts did you say?
I think at least 2 more rate cuts are in the offing in the month of April and June, and possibly maybe 1 more if things start improving.
Okay, now let me come to the liquidity part. This 87,000 crores is coming, will hit the system on the next week, March 4th or something. Does that mean that in the quarter to come, we can see rate cuts from banks? The first rate cut has not gotten passed on to deposits. A few repo-linked EBLR loans have come down. But your chairman himself said it will take a couple of quarters when we spoke to him on Monetary Policy Day. Now with liquidity becoming plentiful, when will the first deposit rate cut come? May? Will you expect it in May?
Latha, I think just give me a minute to explain the liquidity. Yes, the liquidity situation, the Reserve Bank has been making an all-out effort in contain the liquidity, but there are several moving parts in the liquidity. I think there is some interesting observation also if you look into the RBI data. The first thing is that the total portfolio outflow in the last 2 months has been around 1 trillion. So that has been a large number. The second important thing, which is also acting as an elephant in the room, apart from the government cash balances, is the currency withdrawal. And in the last 1 month when this Mohakumbh started, I think the total currency withdrawal from the system has been in excess of 50,000 crore. I think that has a large number. And the third thing is that apart from both of these, the RBI intervention in the forex market from the end of November till February had drained out 2 trillion. But after this buy-sell swap, I think the RBI has recouped around 1 trillion. So overall, the liquidity situation as of today looks a little more comforting, if not, but still the system deficit. I think if you look into the last figure, the net LAF was still in deficit. So while this, and the most important point is RBI is actually facing a challenge of how to compare between a frictional liquidity and a permanent liquidity. If you look at the Reserve Bank of India data for the last 7 days, I think from 10th February to 17th February, you will find that on average, the RBI had injected 50,000 crore more into the system, which was available for auction in the government cash balances, which is a temporary liquidity. So that means the RBI is also replenishing its own liquidity to support the temporary liquidity. So therefore, the permanent and temporary liquidity are getting actually interchanged.
No, Soumya, 1 minute. See, we are talking to a stock market audience, and for them, the big thing is when will liquidity be comfortable enough for a rate cut? Now, one expectation is that in May, Reserve Bank will give 2.5 lakh crore or 3 lakh crore as dividend, and that will substantially solve the liquidity deficit. So, can we expect a rate cut in deposits in May? That's the ask.
I think if I look at the liquidity scenario, it's still in deficit. So even after this swap transaction, around 86,000 crore will flow into the system. But my sense is that the deposit rates are unlikely to be cut very soon. Maybe it will take a couple of months for the rates to be cut only after there is sufficient liquidity. Because I think the Reserve Bank may need to have more liquidity injection in the month of March, given the liquidity disruptions. So my sense is that if that is the logic, I am not foreseeing any deposit rate cuts, at least in the next couple of months.
May dividend, no? When the RBI dividend comes?
Yes, after the RBI dividend comes, possibly if there is 1 more rate cut in the month of June, then actually we could consider some sort of a deposit rates actually coming off the peak.
Okay, now actually for the big question on growth, I saw your forecast 6.2 to 6.3 for the Q3, the quarter that is over, and 6.3 for the full year. What are the chances that growth will be substantially better next year as this, rate cut and liquidity and consumption boost take effect?
See, Latha, I think in terms of the growth for the third quarter, the good thing is that most of the parameters have been looking up, specifically for the rural economy in terms of a real wage growth, in terms of a fertilizer sales, in terms of a tractor sales, in terms of area under Rabi crop. Also, the margins has EBITDA margins have actually turned positive after two successive quarters of negative growth. The capital expenditure by the center and the states have significantly picked up in the month of December. So all this foretold as possibly the GDP growth for the last quarter which went by has rebounded over 6%. But whether it could be more than 6.5% next year still remains, we still remains optimistic on that. But as of now, I think our projections for next year also is at 6.5%. And this year, if there are no major revisions by the CSO on 28, I think the growth rate the CSO had put out 6.3%. That looks a more possibility rather than a 6.6% GDP growth has been put out by the RBI.
Okay. God forbid if it is lower than that, Soumya, if the market is prepared for 6.3, anything lower than that can rattle growth expectations. But let's hope forces will act to recover the economy next year. Thank you very much indeed for giving us a 360-degree perspective on growth, liquidity, rates, dollar and the tariff impact. That's it on this edition of It's the Economy. After a break, it'll be time for Chartbusters.